Assalamualaikum. In this video, we are going to learn a new chapter that is Analysing Financing Activities. Alright, business activities are financed with either liabilities or equity or both. Okay, so the form of financing activities of a business is called company's capital structure. Okay, so we are going to look at the item one by one. We start with the liabilities first. So, we are already learned about the liabilities, okay, which are the liabilities are the obligations that require future payment of money, service or other assets. So, the liabilities classification, we have current and the non-current liabilities, okay, so which is the current liabilities is the obligations that must be settled within 1 year. Alright, while the non-current liabilities is the long-term liabilities, so the obligations not payable within 1 year. Alright, so this one is another alternative classification of the liabilities, which are operating liabilities and financing liabilities. Okay, so we look at the operating liabilities. Okay, this is the obligations that arise from operating activities. Okay, example are account payable, unearned revenue, advance payment, taxes payable, post-retirement liabilities, okay, and other accruals of operating expenses. While the financing liabilities are the obligations that arise from the financing activities, such as we are issuing the short and long-term debt, bond, notes payable, leases, and the current portion of the long-term debt. Okay, next, equities. Equity refers to claims of owners on the net asset of a company. So, example of financing activities involving stockholders' equity include the issuance of common stock or preferred stock. Okay, so when the company issues stock, okay, selling the stock, so when the investor buy the stock, okay, there will be increase in the stock account. Okay, and this one will be reported as positive amount in the our statement of cash flow. So it means source of cash for the company. Alright, so the example of uses of cash, okay, the negative amount or we deduct from our cash flow, statement of cash flow, such as when the company purchase of its own stock and when the company declared dividends and paid on its stocks. Okay, next is capital structure. What is capital structure? Okay, so capital structure is a mix. So this is a mix of a company's long-term debt, specific short-term debt, common equity, and preferred equity. Okay, so the capital structure is how a firm finances its overall operations and growth by using different sources of funds. Alright, so now let's have a look at the debt financing. Okay, the debt financing is when a firm raises money for working capital or their capital expenditure by selling bonds, bills or notes to the investor. Okay, either individual or institutional investor. So when the individual or the institutional investor buy the bond or the bills or the notes, so they become our creditors. Okay, because they lending the money to us. So in return, okay, we are promised to pay back the creditors with the principal and interest, okay, on the debt. Okay, so these are the examples of debt financing, okay, such as bonds, notes payable, short-term loan, leases, and others. Okay, so when the company use debt financing, there is cost of debt. So what is cost of debt? It is the effective rate that the company pays on its current debts. Okay, so this can be measured in either before or after tax return. So however, because the interest expense is deductible, so the after tax cost is seen most often. So because why? It is said that interest expense is deductible. So if you still can recall, okay, in the income statement we start with sales and then minus COGS. Okay, you will get the gross profit, right? Okay, and then you minus with the operating expenses. Alright, and then you will get the earning before interest and taxes. So here you are going to minus with the interest. Okay, and then you will get the earning before tax. Okay, and then lastly you are going to minus with tax. And then you will get the earning after tax. So that's why we said here, because we minus the interest before, okay, we pay the tax. So that's why the interest expense is deductible. Okay, so a company will use various bonds, loans and other forms of debt. So this measure is useful for giving an idea to overall rates being paid by the company, okay, for using the debt financing. And then the measure can also give investors an idea, okay, to the riskiness of the company compared to others, because riskier company generally have higher cost of debt. Okay, next, when a company issues new long-term debt, so it is important for the investors to understand the reason. So we want to know why the company issued new debt. Okay, for what reason? Okay, number one, okay, if the company mentioned to fund the growth, okay, so the cash raised by the debt issuance is used for the specific investments. Okay, so this is normally a good sign. Okay, they want to use the money or the funds for the specific investment. All right, and then number two, if the company mentioned to refinance the old debt, okay, so the old debt is retired and they issue the new debt, okay, presumably at the lower interest rate, okay, so this is also a good sign, okay, but it often change the company interest rate exposure. Okay, next, if the company issue debt to change the capital structure, so the cash raised by the debt issuance is used to repurchase stock, issue a dividend, or buy out a big equity investor. So depending on the specific, okay, so this may be a positive indicator. Okay, but then if the company issue the new debt just to fund the operating needs, okay, so the debt is issued to pay operating expenses because operating cash flow is negative. All right, so this is a red flag. This is not a good sign because the company has to issue new debt to finance or to cover the operation. Ini macam gali lubang, tutup lubang. So they have to issue a new debt because the operation is negative and then to finance the operating activities. So that's not a good sign if the company issue debt, okay, to fund operating needs. Okay, next is lease. Lease is an agreement in which one party gains a long-term rental agreement and the other party receives a form of secured long-term debt. Okay, so the lessee gains a long-term contract for the use of an asset and the lessor is assured of regular payments for specified number of years. Okay, so the parties involved are lessee and lessor. So the lessee is a person who rents land or property from a lessor, okay, also known as a tenant. And then the lessor, the person who rents land or property to the lessee. Okay, and then the lessor is also known as the landlord. All right. So there are two types of the lease. Okay, it can be capital lease or operating lease. Okay, so what are the different? The capital lease or finance lease is treated like an asset on a company's balance sheet, while an operating lease is an expense that remains off the balance sheet. Okay, so the capital lease is more like owning a piece of property. Okay, and then the operating lease are more like renting a property. Now let's have a look at the example. Okay, let's say company wants to buy an asset. Okay, the asset is the machine, okay, which costs RM 100K. Okay, so when the company wants to buy the asset, want to own the asset, okay, the company can actually buy the asset or lease asset. Dia boleh beli or sewa. So what is the effect if the company buy the asset? So if the company buy the asset, it must be recorded on the balance sheet. Okay, it must be recorded in the balance sheet, okay, under the asset. And if let's say the company use debt, okay, to buy the asset, okay, so this is the balance sheet, debt, equity. So if the company use debt, okay, to finance to buy the asset, so it must be recorded here. Okay, so loan, okay, loan on machine, all right, which is 100K. Okay, and at the same time it must be recorded under the asset. So the machine, okay, is 100K. Okay, what happened when the company record them on the balance sheet? Okay, it will affect the solvency ratio. We know that when we calculate the solvency ratio, okay, the total debt must be divided by the total asset, right? So when the debt increase and the asset increase, and so does the solvency ratio. All right. So the business should keep the solvency ratio low. All right. So buying the asset using debt may not be the best option for the company. Okay. So let's say if the company lease the asset instead of buying it. Okay. So when we lease the asset, we don't have to put it in the balance sheet. Okay. We can cap that item off the balance sheet. Okay, we only have to record the lease expense or the rental expense, okay, in the on the income statement, and it will not affect the solvency ratio. Okay, but it only happen if it is the operating lease. All right. So what happen if the asset that we buy is the capital lease? Okay, so if it is a capital lease, it must be recorded on the balance sheet, as same as the case if we buy the asset. Okay, we must record the debt and the asset, and it will affect the solvency ratio. Okay, sekarang now the business want to keep the solvency ratio low. So what is the difference between the operating lease and the capital lease just now? So here's the criteria, the differences between the operating and capital lease. So the operating lease is normally an agreement for rent. Okay, rent. Okay, so this one is the legit lease. Okay, legit lease. And the criteria for the capital lease, this is basically borrowing money for purchasing assets. All right. Okay, number 2, lessee will return the asset to the lessor at the end of the lease period. Okay, but then for the capital lease, there is no need to return the lease asset at the end of the lease period. Okay, sometimes or mostly, the lessee can purchase the asset, okay, below the market value at the end of the lease. And then the ownership title deed of the asset still remain with the lessor at the end of the lessee, while for the capital lease, the ownership or title deed of the lease asset will be transferred to the lessee. Alright, so that's why it is like buying an asset actually. It's not renting. Okay, and then for the operating lease, the predical lease payment of the operating lease to be debited as a lease or rent expense. So this one is to be recorded under the income statement. Okay, and then for the capital lease, the principal amount of lease asset to be recorded at respective asset account, interest to be charged in interest and expense account. Okay, so for the operating lease, there is no need to create asset account, but for the capital lease, yes, you have to create an asset account. All right, and you have to record on the balance sheet. So this one is off balance sheet. This one is on the balance sheet. All right, and then number 6, there is no need to charge depreciation on the asset because the lease asset is not the property of the lessee. And for the capital asset, in the case of capital lease, depreciation must be charged on the lease asset because it will be property of the lessee in the future. So the company wants this classification. The company wants this classification. Company wants this classification. Why? Because they don't have to record the asset, the debt on the balance sheet. They can keep them off the balance sheet. Alright, so they will not affect the solvency ratio. But for the capital lease, okay, it's like a fake lease, and the company actually don't want this classification because they have to record on the balance sheet and will affect the solvency ratio of the company. Alright. Okay, next let's have a look at the equity financing. Equity financing refers to the sale of company's shares in order to raise capital. So investor who purchase the shares also purchasing ownership rights to the company. So equity financing can refer to the sale of all equity instruments such as a common stock, preferred share and share warrants. So common stock, what is common stock? Common stock is common shares, represent a claim on profit or dividend and confer voting rights. So we know that the common shareholder has the voting right. Okay, so investor or the common shareholder most often get one vote per share owned to elect board members who oversee the major decisions made by management. So the shareholders does have the ability to exercise control over the corporate policy and management issues compared to the preferred shareholders. And then the common stock tend to outperform bonds and preferred share. It is also the type of stock that provides the biggest potential for long-term gains. So if a company does well, the value of common stock can go up, but if the company does poorly, the stock value will also go down. And then the preferred stock. Okay, so what is preferred stock? The main difference between the preferred and the common stock is that preferred stock give no voting right. So the preferred shareholder has no voting right. And then the preferred shareholder have the priority over a company's income, meaning to say they are paid dividends before common shareholder. And then the common shareholder are last in line when it comes to the company asset, which means they will be paid out after the creditors, bondholders, and the preferred shareholders. Alright, next is retained earnings. So retained earnings is the percentage of net earnings not paid out as dividends, but retained by the company to be reinvested in its core business or to pay debt. Okay, so it is recorded under shareholders' equity on the balance sheet. In most cases, company retain their earnings in order to invest them into areas where the company can create growth opportunities, such as buying new machinery or spending the money on more research and development. So this is a formula to calculate the retained earnings for the year. Okay, so the retained earning for the year is equal to the beginning retained earning. Okay, ataupun the RE1 is equal to RE0, beginning retained earning, plus the net income. Okay, and then minus with the dividend. So we get the retained earnings for the year. Alright, after we went through all the type of financing, whether the company is using debt, okay, or equity, so we have come to the conclusion that debt is cheaper than equity. Why? Because first, because after have prior claim if the company goes bankrupt, and then debt is safer than equity, therefore give investors a lower return. Okay, so in terms of interest that the company has to pay to the let's say bondholder, so the interest is lower than expected total shareholders return on equity. And then second, because the interest paid is tax deductible. We have looked into this before. Okay, so we understand that the interest paid is tax deductible and a lower tax bill effectively creates cash, okay, for the company. So that's why it is said that is cheaper than equity. Okay, next, what is the optimal capital structure? Alright, so the optimal capital structure is the ideal ratio. Okay, how much we should use debt, how much we should use equity, okay, in our capital structure. So first, optimal capital structure varies by industry. Okay, it is because some industry are more asset intensive than others. So in general terms, the greater the investment in fixed asset the company has, so the greater the average use of that. Why? Because banks prefer to make loans against fixed asset rather than the intangible asset. So the industries that require a great deal of like a planned investment, okay, such as the telecommunications, so they are generally utilized more long-term debt, okay, compared to equity. And then second, capital structure tends to track with the company's growth cycle. So rapidly growing startup and the early stage companies, okay, for example, they are favor equity over debt because their shareholders will forego the dividend payments in favor of future price return. Okay, because these companies are the growth stock types. All right, and then the high growth companies do not need to give these shareholders cash today. Okay, whereas lenders would expect semi-annual or quarterly interest payment. All right. Okay, so I think that's all for this video. Thank you.